Friday, April 24th, 2026. In the high-frequency trading floors of London and the digital exchanges of New York, the week is drawing to a close with what appears to be a sigh of relief. On your screen, the numbers flicker with a deceptive calm. Silver has closed at $75.56. Gold sits at $47.88. To the casual observer, or even the seasoned portfolio manager, these figures represent a market in consolidation, a routine movement of capital, a slight cooling from the volatility of earlier months, a simple data point for the weekend's financial columns. But routine is a dangerous word. It is often the mask that systemic failure wears before the final collapse of confidence. In the world of high-stakes macroeconomics, the most significant events rarely start with a bang or a visible crash. They begin with a whisper in a document that no one reads, or silence in a government department where there should be answers. While the financial media debates moving averages and interest rate sentiment, something far more fundamental is shifting beneath the surface of the global monetary architecture. It is a movement that has nothing to do with technical charts or retail sentiment. It is a crisis of the physical. It is a question of who truly holds the ultimate collateral of civilization, and more importantly, whether that collateral is what we have been told it is for the last 70 years. Consider the fortress. The United States officially holds 8,003.5 metric tons of gold, the largest declared national reserve on the planet. Most of this is supposed to be resting behind the thick granite and steel of Fort Knox, Kentucky. On the government's books, this gold is valued at a statutory price of exactly $422 per ounce. This is not a typo. It is a price frozen in law since 1973. At today's market price of $4,680, the U.S. gold reserve is being carried at a 111-fold undervaluation. To the uninitiated, this looks like sloppy accounting, a quaint relic of a bygone era. To a geopolitical analyst, it is a structural choice. This staggering undervaluation functions as a strategic shield, creating a mathematical fog that makes it nearly impossible to conduct a modern, transparent audit of what the reserve is actually worth, or what it would be worth if a significant portion of it were found to be unusable in the international market. This is the Potemkin Vault theory, a grand facade of strength designed to discourage anyone from looking too closely at the foundation. Why does this matter to the silver holder? Because gold is the engine of the monetary system, but silver is its transmission. When the engine begins to seize, due to internal impurities, the mechanical stress does not stay contained. It vibrates through the entire chassis. In the delicate ecosystem of precious metals, gold's problem is silver's accelerant. When the foundation of the paper-based monetary system starts showing cracks, the pressure bleeds into every physical asset that cannot be printed, replicated, or willed into existence by a central bank's keystroke. The mystery we are uncovering today isn't just about price action. It is about a structural divorce between the paper promises on your screen and the physical reality in the vaults. In 2011, a crack appeared in the facade. The House Committee on Financial Services produced documentation on the physical composition of the U.S. gold reserves that the world has largely ignored for 15 years. Those documents revealed a haunting reality. Out of the 147.3 million ounces of gold held at Fort Knox, only approximately 17% meets the minimum delivery standards set by the London Bullion Market Association, LBMA. To understand the gravity of that 17%, you have to understand the language of central banks. In the modern world, gold is not just a shiny metal. It is a settlement tool. To move gold between sovereign nations to balance trade or settle debts, that gold must be at least 99.5% pure. Anything less is technically substandard. If the 2011 data still holds true, and the government's refusal to conduct a modern audit suggests it does, then the vast majority of the American gold reserve is effectively immobile. It is illiquid. It is a mountain of metal that cannot be used to settle an international obligation without being recast, refined, and exposed to the very scrutiny the Treasury seems desperate to avoid. As we stand here in April 2026, the question is no longer, what is the price of gold? The question is, what is the price of a lie? We are entering a period where the global South and the BRICS nations are no longer willing to accept the paper fictions of the West. They are demanding the physical. They are demanding the 995 fine. And as they strip the available physical gold out of Western depositories, the remaining system is being pushed to its breaking point. What happens to a market when the world realizes the world's largest reserve is trapped in a state of substandard purity? What happens to silver, a metal with an even tighter physical supply and an insatiable industrial demand, when the gold market finally breaks? The calm you feel right now looking at the Friday close is the silence before the transmission snaps. We are often told that the financial system is a masterpiece of complex engineering, but every machine, no matter how complex, relies on the integrity of its individual parts. If the gold in the vault is substandard, if the audits are being silenced by legislative maneuvers, and if the paper-to-physical ratio is expanding to astronomical levels, then we aren't looking at a routine market correction. We are looking at the end of an era of institutional trust. The silence coming from Washington regarding the Gold Reserve Transparency Act of 2025 is louder than any press release. It is a signal to the wise. Behind the $75.56 silver price and the $478.80 gold price lies a reality that the system is not designed to show you. It is a reality of encumbered titles, substandard bars, and a sovereign accumulation of metal that is happening at a pace not seen since the collapse of Bretton Woods. In this 5-part investigation, we are going to peel back the layers of this routine Friday. We will look at why France and Germany quietly moved their gold while the world was sleeping. We will analyze the supply arithmetic that makes a sudden revaluation of silver not just possible, but mathematically inevitable. And finally, we will look at the architecture of the new physical reality, a world where holding the metal you understand is the only way to survive the failure of the paper you were told to trust. The stakes could not be higher. This is not just about a portfolio. It is about the sovereign ownership of truth in an age of digital fiction. Stop watching the chart for a moment and start watching the vault. Because what is being hidden inside Fort Knox is the key to everything silver is about to do. To understand why the current stability of the gold and silver markets is an illusion, we have to travel back to the year 1973, a pivotal moment in economic history that serves as the ground zero for the situation we face today. In 1973, the United States made a decision that would effectively freeze time. It established a statutory price for its gold reserves at a level that has remained unchanged for over half a century. On the Treasury's books, the gold that supposedly secures the American financial system is valued at a static, frozen rate. According to official filings, that figure remains a mere fraction of the market price. The source material cites a valuation of $422 per ounce, a number that creates a staggering 111-fold undervaluation against the April 2026 price of $4,708.80. Why does a modern superpower maintain such a glaring accounting absurdity? This isn't a relic of administrative laziness. It is a strategic architectural choice. By keeping the official book value at a level from another century, the United States avoids the necessity of a modern, mark-to-market audit. If you never update the price, you are rarely forced to update the inventory. This creates a financial time capsule effect, allowing the world's largest reserve to exist in a state of perpetual ambiguity. It is a system where silence is the primary asset and transparency is the ultimate liability. But the silence was briefly broken in 2011. During a session of the House Committee on Financial Services, documents were produced that should have sent shockwaves through every capital on Earth. For over 15 years, these public records have sat in plain sight, detailing the physical composition of the 147.3 million ounces of gold held in Kentucky. The data revealed a systemic quality crisis. Of all the bars stacked within the vault, only approximately 17% meet the London Bullion Market Association, LBMA, minimum delivery standard. The LBMA is not merely a club for gold traders. It is the author of the global rulebook. Its standard, 995 parts per thousand, or 99.5% purity, is the floor for international settlement. If a central bank wants to settle a multi-billion-dollar obligation with another sovereign entity, the bars must meet the standard to be considered deliverable. According to the 2011 records, 64% of the Fort Knox bars carry a purity rating between 899 and 901. The average purity across the entire reserve sits at 916.7. In the cold, precise world of central banking, this gold is substandard. It is effectively a legacy asset, metal that was acceptable in the mid-20th century but is functionally immobile in the 21st. This raises a haunting rhetorical question. If your primary reserve is composed of metal that no major counterparty would accept at face value today, do you actually have a reserve, or do you have a museum? Other nations recognized this sovereignty of purity crisis years ago and acted with clinical efficiency. The Banque de France didn't just talk about transparency, they executed a silent overhaul. They identified their older substandard bars, many of which were held in the custody of the New York Federal Reserve, and matched the purity profile of the Fort Knox inventory, and they sold them. They replaced that legacy metal with 990 fine gold and higher, and brought it back to Paris. Germany followed suit with a massive repatriation effort, ensuring their reserves were not only physically present on domestic soil, but were refined to modern standards. These nations understood that in a geopolitical crisis, goldish metal is not the same as good delivery gold. While France and Germany were modernizing, the United States entered a state of bureaucratic paralysis. The last comprehensive physical inventory of Fort Knox occurred in the 1950s, over 70 years ago. Every contemporary attempt to repeat that process has followed a predictable, tragicomic pattern. In early 2025, momentum seemed to be building for a full review. The Gold Reserve Transparency Act was introduced in Congress, a piece of legislation that would have required a physical analysis of every single bar, serial number, and purity measurement on a 5-year cycle. For a few weeks, the market held its breath. Then, the familiar silence returned. The Treasury Secretary issued a brief statement declaring the gold present and accounted for. The audit initiative was quietly dissolved, and the legislation was allowed to stall in the legislative graveyard. The media, ever sensitive to the next shiny object, moved on. But for those watching the silver and gold markets, that silence was a deafening confirmation. Why abort an audit if the results would bolster confidence? In the world of high diplomacy, you only hide what you cannot defend. The refusal to audit suggests that the 2011 data wasn't just a snapshot of a temporary problem, but a blueprint of a permanent condition. The U.S. Gold Reserve is a giant that cannot move because its very substance is out of sync with the modern world. This historical context is the why behind the how. The underlying factor for the current situation is a decades-long erosion of physical integrity, masked by accounting tricks and legislative avoidance. This creates a vacuum of trust. And in a financial system, trust is like energy. It cannot be destroyed. It can only be transferred. As the credibility of the Western paper gold system is hollowed out by these purity concerns and the lack of transparency, that trust is transferring elsewhere. It is transferring to the physical holders of silver, who recognize that their metal doesn't require a 1973 statutory price to have value. It is transferring to the sovereign buyers in the East, who are no longer asking for paper claims on gold, but are demanding refined, deliverable bars held in their own vaults. The deep context of Fort Knox is a story of an empire that has forgotten that the quality of its collateral is the foundation of its power. We are now living in the era where that forgetfulness is meeting the hard reality of a world that increasingly values what is real over what is promised. The 17% truth is the crack in the dam, and as we move into the mechanics of the system, we will see how that crack is about to turn into a flood. To understand how a system as vast as the global gold and silver market can begin to fracture, one must look at the physics of finance. In a functioning market, the price on a screen is supposed to be a reflection of reality, a digital shadow cast by a physical object. But what happens when the object itself becomes immobile, or worse, when the shadow begins to move independently of the light? This is the technical crisis currently unfolding across the Comex and London exchanges as we move deeper into 2026. The meat of this mechanical breakdown begins with the purity gap. We have established that the average purity of the Fort Knox Reserve is 916.7 parts per thousand. To the layperson, this sounds like mostly gold, but in the high-precision world of international settlements, the difference between 91.67% and the LBMA required 99.5% is not a minor discrepancy. It is a categorical failure. Imagine a high-performance jet engine designed to run on ultra-refined kerosene. If you provide it with fuel that is 8% unrefined crude, the engine doesn't just run slower, it seizes. This is the mechanical reality of good delivery. When a central bank in Beijing or Warsaw settles an account, they aren't looking for goldish bars. They require the 995 fine standard because it allows for instant, frictionless fungibility. 147.3 million ounces in Kentucky, largely composed of coin melt and legacy bars, are technically locked by their own chemistry. To make this gold deliverable in 2026, it would have to be removed, transported to a secure refinery, melted down, purified, recast, and restamped. This process is not only expensive, it is visible. It is a loud, undeniable admission that the existing reserve was not fit for purpose. Thus, the gold stays in the vault, and the system relies on a paper fiction to maintain the illusion of liquidity. This leads us to the load-bearing wall of the entire precious metals market, the paper-to-physical ratio. The Comex and other futures markets operate on the assumption that only a tiny fraction of participants will ever ask for the actual metal. It is, in essence, a fractional reserve system for atoms. For every ounce of physical silver or gold sitting in a registered vault, there are dozens, sometimes hundreds, of paper contracts claiming ownership of that same ounce. The system holds together because of a psychological contract. Traders roll their contracts, they accept cash settlements, and they trust that the number on the screen represents a truth they could access if they really wanted to. But in 2026, that trust is no longer a given. As sovereign buyers like the People's Bank of China and Poland's central bank strip the physical inventory out of Western vaults, accelerating at a rate of over 850 metric tons per year, the physical floor is being pulled out from under the paper ceiling. When the ratio of paper claims to physical metal expands too far, the system moves from a state of fluid trade to a state of structural stress. This is where the transmission between gold and silver becomes violent. If gold is the engine of the reserve layer, silver is the industrial transmission. But unlike gold, which can be held in a vault for a century as a dead asset, silver is alive in the global economy. It is an irreplaceable industrial input. A defense contractor building guidance systems for advanced munitions cannot cash settle their silver requirement. A manufacturer producing photovoltaic cells for the massive solar installations of the 2020s cannot replace silver paste with a derivatives position. In these sectors, demand is not a choice, it is a physical constraint. This creates a fascinating mechanical friction. While the paper price of silver sits at $75.56, the real-world clearing price is beginning to deviate. We are seeing what analysts call quiet friction. Delivery windows, which used to be a matter of days, have extended into weeks and months. Premiums, the extra amount a buyer pays over the spot price to actually get the metal in their hands, have remained structurally elevated. The mechanism of this decoupling is simple. When an industrial buyer realizes that the Comex cannot deliver the metal they need to keep their factory running, they stop using the Comex. They move to private channels, paying $80, $85, or $90 an ounce to secure physical supply, while the official screen price remains suppressed at $75.56. This is a ghost market. The screen shows you a price that no one can actually buy at in volume, while the real trade happens in the shadows at much higher levels. Why doesn't the paper price simply rise to meet the physical price? Because the paper market is a tool of narrative management. If the paper price of gold or silver were allowed to reflect the true physical scarcity, it would signal a catastrophic loss of confidence in the fiat currencies they are priced in. The system uses paper selling, the creation of millions of ounces of virtual silver out of thin air, to dampen price spikes and convince the public that supply is normal. But you cannot build a solar panel with virtual silver. You cannot sterilize a medical instrument with a futures contract. This is the unstable equilibrium. The paper market is trying to maintain a fiction, while the physical world is demanding reality. The gap between 75.56 and the true cost of acquisition is a measurement of the system's desperation. The mechanics of 2026 are telling us that the load-bearing wall is cracking. When the industrial buyer and the sovereign holder both decide to ignore the paper price, the paper market loses its authority. It becomes a decorative number, a relic of an era when we thought we could substitute algorithms for atoms. The Fort Knox problem is merely the most visible symptom of this mechanical failure. If the world's primary gold reserve is illiquid due to substandard purity, then the collateral backing the entire paper pyramid is faulty. And in a world governed by the laws of physics and economics, a faulty foundation eventually yields to the weight of the structure above it. The resolution of this mismatch is never gradual. It is binary. The system maintains the fiction until it can't, and then it reprices in a heartbeat. As we look at the supply arithmetic, the 3,300 metric tons of annual mine production set against a surging sovereign and industrial bid, the conclusion is mechanical. The paper price of $75.56 is not a ceiling. It is a dam holding back a reservoir of physical demand, and the dam is starting to leak. The tremors currently vibrating through the gold and silver markets are not isolated financial events. They are the early warning signals of a geopolitical divorce, a systematic separation of the physical world from the digital dollar-based order. When we observe the current price of silver at $75.56 and gold at $47.0880, we are looking at the final remnants of a unipolar monetary era. The ripple effects of the Fort Knox problem and the Western paper-to-physical mismatch are now radiating outward, reconfiguring the map of global power in real time. To understand the scale of this shift, we must look at the supply arithmetic. Currently, foreign governments and institutions hold over $7 trillion in U.S. Treasury bonds. In the old world, these were considered risk-free assets. In the new world, they are increasingly viewed as digital lines of credit that come with political strings attached. If these global holders decide to reallocate just half of 1%, 0.5% of that $7 trillion position into physical gold, not as a radical protest, but as a routine reserve adjustment, it would create an additional annual demand of approximately 500 metric tons. Set that against the hard reality of geology, global mine production is roughly 3,300 metric tons per year. A single tiny adjustment by institutional holders would absorb nearly 15% of the world's total annual supply. Here is the trap. A gold mine takes 7 to 15 years to move from discovery to first production. There is no emergency supply lever to pull. There is no valve that can be opened to flood the market with physical metal when sovereign demand accelerates. In the physical world, the metal that exists is the only metal that exists. This is why the events of February 2022 act as the ultimate catalyst for the current 2026 environment. When the United States and the European Union jointly froze $300 billion in Russian foreign exchange reserves, they didn't just target a single nation. They changed the definition of money for every central bank director on Earth. They proved that dollar reserves are not sovereign assets, they are permissions. Every director outside the Western alliance reached the same conclusion simultaneously. If your wealth can be neutralized by a keystroke in Washington or Brussels, you don't actually own it. The result is the largest sustained sovereign gold accumulation since the collapse of Bretton Woods in 1971. The 2025 data is staggering. Central banks purchased 863 metric tons, with similar volumes projected for 2026. This isn't trading. These aren't hedge funds chasing a breakout. These are nations like China, Poland, Kazakhstan, and Turkey accumulating sovereignty. The BRICS bloc now represents 40% of all official gold purchases globally. As this physical metal moves from New York and London depositories to Beijing, Warsaw, Astana, and Ankara, it creates a vacuum in the Western settlement system. Each ton of gold that leaves a Western vault is a ton that no longer backs the mountain of paper commitments written against it. It increases the structural stress on every other market that runs on the same paper logic, most notably silver. Silver occupies a unique and volatile position in this geopolitical shift. While gold is the reserve layer, silver is the industrial layer, and it is here that the ripple effects turn into a tsunami. The silver market is significantly smaller than the gold market, meaning it has far less capacity to absorb the pressure of a sovereign exit from the dollar. When the engine of gold begins to seize due to the quality and transparency issues we've discussed, the transmission of silver is forced to handle a disproportionate amount of the torque. The losers in this scenario are the industrial giants of the West. A defense contractor in Virginia or a solar manufacturer in Arizona is now competing for the same physical silver as a sovereign wealth fund in the East. But while the sovereign fund is buying for long-term security, the manufacturer is buying for immediate survival. We are seeing a physical squeeze, where the stated paper price of $75.56 is becoming an obstacle to production. If an industrial buyer cannot secure the silver paste needed for their production line because the physical market is tight, while the paper market continues to trade sideways, they are faced with a choice: stop production or bypass the system. This bypass is already happening. Industrial buyers are increasingly sourcing through private channels, paying premiums that make the Comex spot price a historical curiosity rather than a functional tool of commerce. This is the birth of the two-tier market: one price for the people who trade paper and a much higher real price for the people who actually need the metal. The geopolitical consequence of this is a shift in the center of gravity for value discovery. For a century, the West has controlled the price of precious metals through the alchemy of paper markets. But you cannot use paper to build a guided missile, a satellite, or a renewable energy grid. As the world moves toward a multipolar reality, the power is shifting to those who control the physical flow of atoms, not the digital flow of bits. Who are the winners? The winners are the nations and individuals who realize that the Fort Knox paradox, the silence, the substandard purity, the lack of audits, was a signal to move into physical custody before the exit doors narrowed. The winners are the central banks that rebalanced their reserves while the paper price was still suppressed. The losers are those who mistook liquidity for availability. They are the institutions that believed they could always buy back their position when the time came, only to find that in a physical market, when the metal is gone, it is gone for a generation. The $7 trillion treasury overhang is a dam holding back a sea of physical demand. As that dam leaks, the pressure concentrates at the narrowest point of the system, the physical silver market. Silver at $75.56 is not a reflection of a balanced market. It is a reflection of a system trying to ignore the laws of physics. But geography and geology are patient. They do not care about paper contracts or routine Friday closes. They only care about what is in the vault. And as the vaults of the West empty into the vaults of the East, the ripple effect will eventually become a wave that reprices every asset on Earth. The story of Fort Knox is not a conspiracy theory, nor is it a simple tale of missing bars. It is something far more profound. It is a study in the architecture of silence. In the world of high finance, what is not said often carries more weight than the loudest headline. As we look at the close of this Friday in April 2026, with silver at $75.56 and gold at $4,708.80, the most significant data point is the void where a physical audit should be. The 2025 attempt to pass the Gold Reserve Transparency Act did not fail because of a lack of evidence or interest. It failed because the system reached a conclusion that the cost of transparency had finally exceeded the cost of continued ambiguity. When the Treasury Secretary declared the gold present and accounted for, and the media moved on, it wasn't a resolution. It was a strategic retreat into the fog. In a world where the majority of your reserve is composed of 91.67% fine legacy bars that fail modern settlement standards, transparency is not an asset. It is a death sentence for the status quo. For the individual holding physical silver, this silence is your strongest signal. We are witnessing a slow-motion collapse of the paper standard. The mismatch between the digital claims on your screen and the physical atoms in the vault has reached a terminal velocity. In every recorded financial crisis in history, such mismatches never resolve through a gradual, polite adjustment. They resolve through a binary event. The system maintains the fiction that paper and physical are equivalent until the very second it cannot, and then the market breaks. It does not lean, it falls. This brings us to the most sophisticated tool currently deployed against the physical holder, boredom. Fear is an amateur's tool. Fear creates urgency, and urgency often leads to a hunker-down mentality that actually strengthens a holder's resolve. But boredom? Boredom is the ultimate psychological weapon. By keeping the paper price of silver pinned in a sideways grind while the rest of the world's inflation metrics continue to climb, the system attempts to exhaust your conviction. It waits for that moment on a Friday afternoon when a holder looks at the stagnant screen, looks at their mounting bills or other high growth opportunities, and decides to take the cash. But look closely at who is on the other side of that exit. Every ounce of physical silver or gold sold by a weary retail holder in the West is not being liquidated, it is being transferred. It is moving into the hands of the sovereign accumulators. It is moving into the vaults of the People's Bank of China, which has added to its reserves for over 18 consecutive months, regardless of the price. It is moving into the private stockpiles of industrial giants who have stopped listening to the Comex narrative and started securing their own supply lines. These are not momentum traders who will sell on the next 10% dip. These are entities building the foundation of a new monetary order. They are buying your boredom because they understand the purity. The future outlook is not a matter of if, but of how. The decoupling of paper and physical prices is already visible in the elevated premiums and the extended delivery windows. As we move deeper into 2026, we should expect this quiet friction to turn into loud failure. The moment a major industrial buyer or sovereign nation attempts to pull a significant amount of metal out of the system and is met with a cash settlement instead of a delivery, the paper market loses its function. At that moment, the reference price of $75.56 becomes decorative. The real price will be whatever number is required to convince a physical holder, someone who understands the 17% truth of Fort Knox, to part with their metal. We are standing at a philosophical crossroads. On one side is the economy of bits, a world of infinite digital replication, unbacked paper claims, and an architecture of silence designed to protect substandard reserves. On the other side is the economy of atoms, a world of irreplaceable industrial inputs, sovereign physical custody, and the hard, unyielding reality of geology. The final verdict is this: you cannot solve a physical shortage with a digital solution. You cannot refine 91% gold into 99% gold with a press release, and you cannot satisfy the structural demand of a global technological revolution with paper contracts. The Fort Knox problem is the ultimate proof that the foundation of the old system is hollow. The silence around the audit is the admission. As the Asian guy, my message to you this Friday is simple. Hold what you understand. The noise level will continue to rise. Analysts will continue to speak of normalization, and the screens will continue to flicker with prices designed to make you doubt your own eyes. But the data hasn't changed. The purity records haven't changed. The sovereign accumulation rate hasn't changed. The only thing that changes is your level of patience. The people who own the physical metal today are the people who will write the rules of the transition tomorrow. They are the ones who looked at the 2011 documents, saw the 17% deliverability rate, and realized that in a world of universal deceit, holding something real is a revolutionary act. While most people are still staring at the paper price, you are now looking at the vault. Don't be distracted by the noise. The signal is in the silence. This has been a breakdown of the structural reality beneath our feet. If this analysis helped you see the world more clearly, the path forward is yours to take. Friday, April 24th, 2026. The price is just a number. The metal is the truth. Hold your position. Watch the vault. Stay sovereign.